By now, we are all too familiar with the silver squeeze and the different iterations of it through the course of the last several years. But what about the concept of a gold squeeze and the most unlikely source of where it could begin? We're going to talk about it in this video and how it could lead to big trouble here for the United States. So let's explore. Gold is a metal that most of us understand to be far more stable and, as far as its supply is concerned, pretty much concentrated as a store of wealth. In fact, that's one of the downsides to holding gold is that, it's not really consumed nearly as much as silver is. And silver is a metal that we've seen fluctuate in price dramatically over the past year and even couple of years. But for the first time, we're hearing about the concept of a gold squeeze and where it could come from. I'm going to be referencing an article from Numismatic News that sends us really across the globe spinning around to get an idea of where this squeeze is going to occur and what kind of effect it could have on us here in the United States, because it's happening on the other side of the world, or it could be. The United States government has been manipulating the price of gold since the Exchange Stabilization Fund was established back in 1934. One of the fund's explicit purposes is to manage the price of gold. And the price of gold and silver essentially are effective report cards on the U.S. government's economy and the dollar. If the prices of these metals are rising, it's a negative signal for America, and that really is true. And look where gold is right now, trading near all-time highs in nominal dollars, and at a pretty consistent rate. In fact, as I record this video, gold's price is rebounding from a recent dip that had occurred, and it didn't take very long. And I think we're going to see prices hold fairly steady from here on out for the rest of the year. It would be counterproductive for the U.S. government to be seen directly trading in gold markets. Consequently, its price manipulation tactics are conducted by other parties. Among these collaborators are the primary trading partners of the Federal Reserve Bank of New York, allied central banks, the International Monetary Fund, and the Bank of International Settlements. So essentially, we're looking at a pretty big cabal there of central banks and global institutions, for sure. The tactic would be to sell short paper futures contracts on the New York COMEX. Selling short contracts not backed by physical gold gives the appearance of larger gold inventories on the market than there are, helping to hold down gold's price. It's derivatives. And we know about the derivatives market, and I've actually outlined that before many times on this channel with gold, but especially for silver. But we have to recognize that it is indeed there for gold as well. Although the U.S. government has access to the greatest resources to impose its will on international markets, it does have a significant weakness. If you combine the outstanding U.S. government debt of almost $35 trillion, it's 34.95 right now, with the net present value of unfunded liabilities for Social Security, Medicare, and related programs. Depending on interest rate assumptions, the gross amount owed is somewhere around $200 trillion. That's right. The unfunded liabilities and everything that's associated with it is much larger than the $35 trillion that we're looking at right now. The federal government is easily in the hole by at least 100 of those $1 trillion. That makes America the worst, largest debtor nation. That's big trouble, folks, of the entire world. And when comparing what is owed in relation to the gross domestic product, the U.S. ratio is approaching 500% when you account all of those unfunded liabilities. 500%, which is by far the highest of any nation. And Japan, which is known for being a debtor nation, is a distant second highest in government debt divided by GDP. That is mind-blowing, folks. We are in bigger trouble than we think. But the thing is why are our politicians and really most economists not worried about it? Because of the strength of this compared to other currencies out there. We may be the worst in debt, but until people really lack faith in the dollar, well, it's going to continue. The dollar's hegemony is something that is not to be reckoned with. It's a force to be reckoned with, and it's going to likely continue until really people understand what I just told you and what Patrick Heller here, the author, just told you. We are a debtor nation and the worst. The U.S. government's extremely high debt and liabilities put downward pressure on the value of the U.S. dollar. It simply won't be possible to pay off all the debts and liabilities in U.S. dollars of the current purchasing power and the system that we find ourselves a part of these days. The competition for international dominance involves more than military actions. Financial clout can also inflict damage and chaos on opposing governments. This year, demand for physical gold in China has been so strong that there have not been enough supplies to meet demand. Now, that's a hint of a gold squeeze, but nonetheless, what we've seen the past 2 months is sort of a pause on that, at least by official numbers, as they have literally paused buying gold for 2 months straight now. And who knows, we may see a third month straight here with July almost wrapping up. And so to satisfy demand, with investment demand being up more than 26% in the first quarter of 2024 compared to a year ago, the public has been buying gold contracts on the Shanghai Futures Exchange. The Shanghai Futures Exchange you've heard me talk about a lot on this channel, especially with silver but also with gold too, as their prices are higher because of this. And a month or so ago, the Chinese government directed the nation's media to urge buyers having difficulty finding gold to instead purchase physical silver. We've talked about that. And that's been a remarkable thing to see, although industrial demand for silver has actually fallen in China because of their problems. They have problems of their own. They had a 5-year economic forecast that has just come out that has put a squash kind of on economic activity and has really sent silver plunging pretty dramatically. That's one of the biggest reasons why it's fallen, but not so much with gold. Gold has fallen, but not nearly to the amount that silver has, and I think a lot of it has to do with China. And so one Chinese company owns about 1 million ounces of gold contracts along with some silver contracts on the Shanghai Futures Exchange. As these contracts reach maturity, they ask for delivery of the physical metal. Let me read that again, because that is something unique to China, not here to any company in the United States. They own about 1 million ounces of gold contracts along with some silver contracts on the Shanghai Futures Exchange. As these contracts reach maturity, they ask for delivery of the physical metal. They're also asking for physical delivery of silver contracts as they mature. Now, I don't think there's enough silver there to really cause a squeeze in and of itself, but it could rock the silver markets, and we could see silver really perform and shine once these contracts expire. This is sharply different from trading of futures contracts in the United States, where maturing contracts are mostly exchanged for new contracts with delivery dates further in the future. It's one big kind of seemingly Ponzi scheme, if I may be so bold in my language there, trading for one, with other contracts with new delivery dates. It's insane. The company's demand for delivery of physical gold upon maturity of the futures contract would magnify a supply squeeze for gold. That's right, a supply squeeze for gold, which we've never really heard much before. Why? Well, because gold is mostly stored and consumed. And so there's enough of it that can be traded back and forth. But with these companies doing that and asking for delivery, there's your supply squeeze. Wow. This will put pressure on higher gold prices, leaving short sellers of futures contracts in a growing loss position. That's right, which means that we could see gold indeed break out far beyond, yes, I'm going to say it, the ultimate high price adjusted for inflation. I'm talking about $3,200, $3,300 gold could come from this if what he's saying is true and they really do want to get these deliveries in place. Now, on June the 25th, 2024, the open interest in the COMEX gold futures market was 452,190 contracts. That is over 45.2 million ounces of gold. And their demand for delivery of physical gold upon maturity of a futures contract would magnify this supply squeeze, as I mentioned before. And by July 19th of this year, the open position has soared to 584,673 contracts. That is an increase, massive increase, reaching 48.4 million ounces of gold. The additional short sales of 13,248 ounces of gold in less than a month represents over 6 weeks of global gold production. Wow. Each of these contracts has a party on the long side that owns it and a party on the short side that owes the metal. Yeah, that's right. So normally when such a massive quantity of gold is sold short, the price plummets. That did not happen this time around, with the price reaching an all-time high on July the 16th, 2024, ignoring the impact of inflation on money supply. And this Chinese company effectively controls more than $2 billion worth of gold. That's a massive amount. It is inconceivable that it could own such a large position without the Chinese government knowing about it. Yeah, that's stating the obvious, isn't it? And it most certainly condones it. It is also entirely possible that the Chinese government may be collaborating with this company as a tactic to undermine the future value of the U.S. dollar. You strengthen gold, you're going to weaken the dollar, even no matter what the Federal Reserve does. That is very likely that could happen. When the U.S. government flexes its financial resources, almost no entity wants to be on the opposite side because of the weakness caused by the U.S. government's massive debt and liabilities, and may be up against an opponent who has the financial wherewithal to overcome the federal government. And you know what? They have a motive, not only because they are an enemy of the United States, but also their economy's in trouble. They need to do something desperate. And, with tariffs and the like and happening or potentially could happen that could damage our economy even further, they need to bolster up gold and their reserves. More than likely, China may have more gold than what we are being told, and it would not surprise me if that were the case. And if they own nearly as much gold as the United States does, well, they have really, in a sense, strengthened their position because gold is the ultimate money. As this plays out in the coming months, it probably makes sense to maintain and maybe even increase one's holding of bullion-priced physical gold and, yes, even silver. Because silver could be affected as well, too, if it plays out like the author is saying here, Patrick Heller. Now, that's just it. Will this play out in the coming months? Will it be 6 months? Will it be within a year? Or what have you? We don't know. But this could be coming. And it's very likely, especially if it holds true that this big company will actually ask for physical, then all bets are off the table. Let me know what your thoughts are in the comment section down below. Hope you found this video informative, insightful, and inspirational. I would like to extend a multitude of gratitude to each and every one of you for taking the time to watch, and to encourage you to please rate, share, comment, and subscribe.